The best part of our returns are behind us, but this goes to the view. We've seen this quite coalescing about de-risk, de-risk, de-risk. But is it time to de-risk or just hold your nerve and see what this earnings season delivers? Good morning.
Good morning. I think bottom line, we are constructive, certainly on the year ahead for multi-asset investors. I think that we're starting with a bit of New Year's jitters for the reasons that you highlighted. But I think when we look at the slate of opportunities in the year ahead, we are more optimistic than not. For one, when you tend to, historically speaking, invest around near all-time highs, that does tend to signal, strong returns into the year ahead. Going back over the last 50 years, if you had invested at an all-time high, your 12-month forward return would actually be higher 70% of the time, with a median return of around 12.5%. If you didn't invest at an all-time high, that's around a 10.5% median return. So all that's to say, there's not a meaningful difference. And then I actually think that we are in a bit of a sweet spot when it comes to equity markets now, where you're looking at moderating inflation, that really the nascent stages of earnings growth. Yes, we've seen some downward revisions. That tends to happen in your typical year, but we are constructive into the year ahead. And then I think you also, when you factor in the Fed easing, we do think that is an optimistic backdrop to be an investor.
I take it you would disagree with what Lori Calvasina had to say in a note. Let me just quickly read it to you, Madison, but I can feel the disagreement coming. She's talking about valuations. She says that valuations are now clearly expensive for the median stock, a change from a few months ago when valuations for the median stock looked more reasonable under model flows. She's talking about tech here have also turned negative rather abruptly. So as a whole, she says that tech stock valuations, I should have been clear, this is all about tech. And that's why she's downgrading tech. So would you say to that, I don't care about tech valuations, I can still buy right now?
I think you certainly need to care. I mean, not all tech is created equal, but I think, to that point, on a broad perspective, we do need to keep that tech rally in context. The last couple of years before last year were very difficult for tech. We actually just regained the previous all-time highs in the Nasdaq and the Magnificent Seven in November and December. So we're really, I think, looking at a more modest rally when you look at it from that perspective. But then I think the more interesting part is when you, I think, compare the quality of tech to the broader market. So you're looking now at free cash flow that exceeds the broader market. You're looking at, high and stabilizing margins. And then I think when you actually adjust for the long-term earnings growth power, actually valuations for tech could even arguably look more reasonable versus the median stock.
Part of the argument, of course, with big tech is that they did part of their catharsis last year. They did their job cuts maybe a little bit ahead of everybody else. They've got stronger balance sheets and they're doing well in a higher rate environment. Where do you stand on the great breadth argument? We've had them piling up day after day after day. Go for breadth. There's 493 other stocks. How do you manifest going for breadth, if at all?
Sure. I think this is a good year for breadth. I think two things can be true. I think ultimately technology stocks, particularly the ones that are exhibiting high quality earnings growth, can continue to rally. But at the same time, in a soft landing scenario where you're entering in this sweet spot for equity markets broadly, I do anticipate seeing more of those cyclical sectors start to participate in that rally. And there is, I think, meaningful room for further upside there. I mean, when you look at small caps, when you look at mid caps, when you look at financials, yes, you've seen a rally over the course of the last 2 months or so, but certainly still lagging the broader market. So I think ultimately that leads us to a constructive stance for equity market investors.
I'd say it was really interesting. Madison and I spoke with Max Kettner of HSBC yesterday, who said a lot of what you're saying, that the fundamentals actually look very strong. Growth is okay. Equity earnings are going to be good. But the issue for him was that the bond market rally has just gone too far. And that's going to undo itself. Yields are going to push higher. And just because that strange relationship between yields and stocks will fall because of that. What do you make of that argument? Are you also worried about another higher in bond yields?
I wouldn't necessarily rule it out. I think we certainly could see some volatility within bond yields, especially as we go through these, catalysts of Fed meetings and inflation prints like we have later this week. But I do think while, we're anticipating slightly less rate cuts than the market is at this point, bond gains and stock returns tend to be quite constructive in soft landing scenarios. I don't anticipate that bond yields are going to fall dramatically from a longer dated perspective given the decline that we already saw last year. But I think when you think about what that means, it means you still have a very strong carry opportunity within fixed income, even if you're not seeing huge capital appreciation potential.
And just on that, PIMCO were with me yesterday, and they were saying now is at this point we don't see duration extension as a compelling tactical trade. Many people talk to Danny and I, they say they want 5s, they want 7s, they want the belly of the curve. Where are you on duration? Do you want to be a hero?
Yes. So I think it's about what your goals ultimately are. I think tactically, our preference is for shorter durations. So think about that 2 to 3 year space where you're still looking at very elevated yields that stand to fall as the Federal Reserve starts cutting interest rates. But to the point, we were just discussing from a strategic positioning standpoint, we are still in a very new interest rate regime. Bond yields and from the longer end of the curve are still far higher than where they've been over the course of the last decade. So while you might be, I think, outside of that tactical opportunity from a strategic perspective, I think long-dated bonds really serve that portion of the portfolio to provide income. And by the way, if we are wrong and we do see a recession, you would see yields fall. And we do think that bonds can provide protection in that scenario.